Maybe now? Oh, I see it. I see it moving. We're good. Hello, hello.
We're back. Actually, we've been here the whole time.
But I think you can hear us now. Thank you for letting us know in the chat that you could not hear us.
Yeah. Now
take two.
Yeah, now we gotta do that all over again. There was some good stuff in there.
Oh boy.
But at least you missed us talking about how we heat our house. So we won't go over that again.
It's a wood stove, by the way.
Okay, you do have to hear it apparently. Jeff couldn't let you leave without that.
I like the wood stove.
Jeff couldn't let you leave without knowing that. Okay. So we were talking
Welcome to our power lunch.
Yeah, we were talking about what our topic is today. And it was really inspired by a lot of the conversations that we've been having recently with different investors. And for those of you who were at our talk, which some of you in the chat were at our talk last week. Oh my gosh, it was already last week.
That was a good event.
Yeah. So
thank you to everybody that came out. That was a lot of fun.
And for those of you who missed it, I'm sorry, but you missed out. It was a lot of fun.
We might be doing another one, so stay tuned.
Yes, stay tuned. It'll probably be a very similar style, maybe even a similar topic. We'll see, to be determined. But for those of you who did come out, again, like Jeff said, thank you so much. Part of what we're talking about today did stem a little bit from our conversation in that room, because a lot of the focus was around having different tools in your tool belt. And I think that's really important right now as things shift. Things are very different than they were beginning of 2022. The market has changed, real estate's changed, and it doesn't mean that we have to step out of the market. It doesn't mean that we can't be investing in real estate. It just means that you might have to take out a different tool for this point, or match different tools together to be able to get the job done.
Yeah, I'm hearing far too often that there are no deals out there.
Yeah. And this is where this conversation comes in, because it just takes maybe shifting some perspectives, getting some new ideas, and maybe looking at deals a little bit differently.
Yeah, having those tools in your tool belt to be able to create deals.
Yeah. Before we get started, thank you, or hi to Jasmine, Sahar, Haresh, and Brian for being here. If you haven't said hello to us yet, please make sure you say hi to us in the chat. We like to know who is here and who we're chatting with.
We also want this to be interactive. So if you have questions, feel free and post them. If you have comments, if you want to challenge anything that we're saying, absolutely. We want this to be really more of a discussion. So
yeah,
please type in the chat.
Give us your input. We'd like to hear from you. Mm-hmm. So our topic for today is kind of broad, and I think it can bring up some interesting conversation, much like the topic that we did at our chat last week. And the focus for today is really like, how do we keep up with what's happening in the market? Because what may have been working in the beginning of COVID or in 2021 might not work now, and we might have to switch how we're approaching projects and how we're approaching real estate in general to be able to make deals work.
Yeah, and this is not a market update. That's not what we're doing. We're not doing a market update. We're not realtors. We're investors, and we shift how we invest. We shift our strategies based on what the market looks like.
Yeah. And I think that's where being a sophisticated investor really comes in, because you have the ability to shift. Like, if you think of, and this is an example that one of our mentors uses all the time, is if you're like a professional hockey player, if you watch hockey, they're changing the rules all the time. I know for myself, I'm a synchronized skater, and they give us new rules every single year with new elements that we have to do. And, we don't just throw our hat in the ring and say like, we can do this, or we take it out and we're like, yeah, this year I don't want to learn this element. I don't know how to do this. We don't take ourselves out of the running because of it. We learn that new element, and we're able to do that because we have the skills to be able to transition into something new.
Yeah, to be able to pivot.
Yeah, and I think that's a really important thing to be able to do in any area of your life as a professional, and it's the same in real estate.
Yeah, I really like that NHL and the rules analogy because you have the fans that are watching the game. They're not the professionals, and they're sitting there complaining, oh, I hate this new rule that they added, yada, 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 complaining about it. But then you have the professionals that are playing the game. They're dealing with those new rules, but they're just changing their strategy to fit and to accept the new rules and continue on.
Yeah. It's always a big discussion for us every year when we're starting our synchro season. There's always wild stuff that comes out, but we keep up with it, and it is what it is. So one of the big things that we've heard a lot, and I think you've said this already, and actually Brian's mentioned it already, is the creative financing. And this is where having different tools in your tool belt is going to be really important, because we hear so many people talk about how, like Jeff said, there aren't any deals anymore. They can't find any deals. There's nothing on Realtor. There's because apparently that's the only place that people go is on Realtor. There's nothing out there anymore for deals. And yet you see some people, they're doing it. They're closing on things. They're getting it done.
Yep.
So what's the difference between the person that can't find anything and the person that's getting it done?
Well, the way that I always say it is that the best deals are never found, they're created. Mm-hmm. Right? So that's the difference right there. They're creating a deal. They found some form of an opportunity in what other people may just look at and say, it's not a deal.
And again, this is where having different tools in your tool belt is really important, because a lot, like what Brian said, finding a motivated seller. So not just finding a motivated seller, but what's motivating that person.
Yes. Finding the seller's motivation is the key.
Yeah.
Yeah. So not just motivated sellers, not just somebody that's going to be selling off market because they're in an obvious distress situation, but finding out why is somebody even selling the property that they're selling.
Yeah. And you're not out there to try to take advantage of people. You're out there to try to be a problem solver. So figure out what their issue is. Like, did they get, is their mortgage, they have to get a new mortgage and now they can't pay that mortgage anymore. Maybe they're just done with tenants and they want to be out of the game. There's different reasons for someone to want to sell, and you just have to figure out what that reason is and become a professional problem solver. Mm-hmm. And that way you're not taking advantage of anybody. You're helping that person get out of whatever situation they're in. And then they benefit from that. Obviously, you benefit from that because you're able, likely, hopefully, if all goes well, you're able to take over that property and now own it.
As Brian said, create a win-win situation. Exactly. That's exactly it.
Yeah.
Right? So get what you want, but also give what they want. And that's how you're going to be able to come out with the best win-win.
Yeah. And it's not just knowing like one creative solution, right? And that's where, again, you want to be able to build all of these tools in together, because maybe it's a combination of having a certain closing date. Maybe it is throwing in some creative financing, like a vendor take back, or doing an agreement for sale, or making some sort of agreement with that seller to figure out how to get this thing over the finish line. And it might not be one of them. It might be a combination of a couple of them.
But don't just like put in your offer and say, are you open to a VTB? Can we do a agreement for sale? Can we do this? Can we do that? All these things all at once. It's not that, if it doesn't fit the situation, there's no point in bringing it up.
Yeah. And that's where you have to know how to use these things.
Yeah. And
again, these are all kind of steps, I think, of sophistication when it comes to being an investor is, do you know creative strategies? Okay, that's great if you know
when
them.
to apply those creative strategies.
And then I took it from you. I think even beyond that, do you then know how to educate somebody else on why that creative strategy is important? Because it's one thing to know about it. Like, I think everybody's heard of a vendor take, well, not everybody, but a lot of people have heard of what a vendor take back is, right? So it's one thing. You have to know what it is. You have to know how to use it. That's another step. You have to know when to use it, when it's going to be beneficial. And then you also often have to educate sometimes the realtor. Sometimes you have to educate the seller. Sometimes you have to educate everybody that's involved in this transaction, not only what a vendor take back is, but how it can benefit them. And like Jeff said, you're not just going in and like, vendor take back, I want it. Because maybe it's not even good for that situation.
It might not be helpful at all.
Yeah. And I've seen that. I've seen people offering vendor takebacks. I'm like, that actually makes the deal worse.
Yeah. Now you're adding more debt that maybe you didn't need to add originally.
Yeah, like it.
So I guess something that you're kind of alluding to is why that creative strategy,
Yeah,
not just the how to use it and what it is, but why would you even want to use it in this specific scenario?
yeah. Haresh is asking, how do we find the motivation of the seller? So this obviously this is going to depend on how you're getting to that seller. Sometimes if you're off market, it's going to be a little bit easier. If you're finding something on market or you have realtors that are involved, it's going to be a little bit harder. Haresh, I know you were at our talk, so you'll have an idea of how things can differ if there's people in the middle. In the end, I think what it comes down to is building that rapport with the other side.
Yeah. Well, what's the very first question? Why are you selling? Or why are they selling? Right?
Yeah.
Like, there's no shame in asking that question. You want to understand their motivations. You want to be able to come to a win-win situation.
And
So,
sometimes they might not answer fully. Like they might give you a partial answer at the beginning because they think that if they show their cards, then their cards are laid on the table, someone's going to take advantage of them. So this is something that you might have to kind of massage out as the deal goes forward, and you might learn pieces as you go. But it comes down to just being really good at discovery, really good at building rapport, letting them know that you're there to work with them, not to work against them, or not to like
take
try
advantage or anything like that.
Yeah.
Right.
Like you're there to try to create the best situation possible. And it's not always easy for everybody to do that, and it takes practice. And I think that's a big thing is practicing how to build that rapport. It was something that in medicine we're taught how to build rapport, but you have to practice. And I remember I was pretty good at it, but you're still practicing it as you do it. And it's the same here as well. So starting off with a good discovery, but then continuing that discovery throughout it.
That should be ongoing.
And listening for hints. So if something doesn't quite align with maybe something they said in the initial discovery, ask about it, right? And don't ask in like an intrusive way. Just say like, maybe if this information might actually help us create a better situation, like let them know why you need that information.
Yeah.
So just always be listening.
I feel like a lot of people approach real estate transactions like it's a dog eat dog world. Like it's you against them. It's the buyer against the seller. I think for people that kind of approach the situation like that, I really think that you should shift your perspective to try and create those win-win solutions. Be a professional, right? Try and really discover what they need and what their motivations are, and do it from an authentic perspective. Don't do it from I want to know what all of your cards are so that I can beat you. That's the wrong approach, and people are going to see right through that.
Mm-hmm.
You want to be a professional, and you want to be respectful. You want to actually build rapport.
Yeah.
Not fake it.
Yeah. And I mean, Haresh, you said use the love letter. That could be something we haven't necessarily built. We have built rapport using love letters, but
we've gained trust using the love letter.
Yeah. So you could try that. It's kind of a different spin on the use of a love letter.
For those of you that don't know what that is, send us a message and we can
chat.
We can help you with that.
Yeah.
We've talked about it before. We're not going to get into it this talk.
Yeah, we could spend the rest of the conversation on that.
Yeah, that's at least an hour conversation.
Yeah. So, yeah, I think it comes down to just building that rapport with the seller and letting them know that you're there to help them, like you said, not to butt heads with them.
Mm-hmm. Yeah, not combative.
Yeah. So tools in your toolbox, getting creative, becoming a professional problem solver, that's going to help you, I guess, find more opportunities in the market. Also getting creative with how you're finding properties. So instead of just going to onto Realtor, trying to find stuff off market. And there's a ton of, again, this is like a whole other topic on how to find off market properties, but like learning how to do that, how to find opportunities in different ways, building your network, getting to know people who own properties, getting to know people who own properties, all ways of getting potential off market. And again, another tool in your tool belt that you can add and you can take out when you need it.
Brian, send us one of us a DM, and we'll chat about it.
And I know, so another one that we've talked about with a couple of people, and we've seen this as a bit of a trend on both people who want to get involved in projects more from a passive perspective, and also people who are, I guess, talking about their projects from a more active perspective, is the BRRRR project.
The perfect BRRRR.
The perfect
How many people
BRRRR.
here have heard of the perfect BRRRR?
This has become a tricky one.
Yeah.
In the last year and a half.
When the market looked like this, that was easy. The perfect BRRRR was simple.
You basically
you just kind of fell into a perfect BRRRR, right?
Yeah.
During COVID, during the hyperinflation, right? Like, that's when the perfect BRRRR worked, and it just kind of worked by default.
Yeah, and things have changed, things have shifted, and we've had this discussion with a lot of people about, what does a BRRRR look like in today's market? Does it look like you're getting your money back in 6 months to a year? Does it look like maybe you're getting your money back a little bit later, and maybe that's still a perfect BRRRR? Because no one, like, the perfect BRRRR just means that you do the project and you take your money out.
Yeah.
There's no real timeline to what a perfect BRRRR really means, right? As far as I know, there's no real definition of what makes it perfect other than you put your money in, you take your money out.
We're throwing this around, and I feel like there might be some people that don't know what a BRRRR even is. So just for those people, it's buy, renovate, rent, refinance, repeat.
Yeah.
So you pull your money out and you do it again. That's a really quick version of it, just what it stands for. Essentially, you're doing some sort of value add, and then you are with the renovation, and then you're refinancing to get that money back out. The perfect BRRRR is where you get 100% or more of the initial capital that you put into the project.
Yeah. And as you can imagine, during COVID, when the market was skyrocketing, inflation was high, it was pretty easy to kind of predict and know when you were going to have your, I guess we couldn't even predict at that point. We just kind of knew the market was skyrocketing, and if we held it long enough, you'd probably get your money out. Mm-hmm. So it was a lot easier to say, we'll take this property, we'll add a ton of value, and then we'll refinance it in a year, and everyone is going to get their money back.
Kind of like a flip, but you're holding the property, and you still have, you still have your mortgage, you still own it. You just take it. You've taken all your money out.
Yeah. And today, we've all seen in the market's not doing what it was doing in 2020, late 2020, 2021, and beginning of 2022. And the perfect BRRRR has
Thanks for hanging out, Brian. Good luck in your negotiations.
Yeah. Well, I'm sure we'll be chatting with you at some point about love letters. So yes, BRRRR has become a lot more difficult. And this is something that maybe I think some people need to start to wrap their head around, that it might not be quite like what it was like a year and a half ago, or probably more like 2 years ago. So for us, what we've talked to people that either we're working with or that are maybe doing their own projects is to kind of reset your expectations. And it's not that the project is a fail or it's not a good project if you don't get your money back in 6 months to a year. It just means that you have to, I guess, change your mindset around what that perfect BRRRR looks like. So it might be that now you hold the project for 5 years until maybe you have a 5-year term and it's up, and then you do your refinance, or 3 years and you do a refinance, or maybe you don't pull out all of your capital at that point. And it could be that the property value didn't go up as much as you thought. It could also be that financing is expensive and you can't pull out up to whatever 80% loan to value if it's a residential mortgage, or less if it's commercial.
Yeah, in case you don't cash flow, right?
Yeah. So it might mean that you're setting different expectations for the project and making sure everybody involved is in line with those expectations. And if your if you're promising this to maybe somebody who's involved in your project, if you're promising a 6 month to a year turnaround, you need to really look at those numbers and make sure that you're not promising them something that was happening in 2021, but now it's 2023 and things are different.
Yeah. We're not saying that the perfect bird doesn't exist. We're not saying that you can't get your money back in 6 months. It's possible, but really look at your numbers and really make sure that you have that, we'll call it after repair value, concrete.
Yeah. And I think even on the flip side, if you're looking, if you're someone who's looking to get involved in somebody else's project in some capacity, and they are saying, we're looking at 6 months to a year, really dive into those numbers, because that's something that isn't as common as it was 2 years ago, 3 years ago. So really take a look at what those projections look like and where they're coming from, and ask questions. Make sure that they've actually taken into account, what if, they're saying interest rates might go down. What if they don't go down, right?
Mm-hmm.
Like, what if, I know especially for us in the commercial space, the bond market has pretty much been going up, right? And we don't really know we don't have crystal balls, right? Like, we don't really know what's going to happen in 2 to 3 years.
Yeah. And your active investor doesn't have a crystal ball either.
Mm-hmm.
No matter what they say. They may tell you that they do, but.
Yeah. So ask a lot of questions. If that's the promise that's coming out of the project, ask a lot of questions.
Yeah. You're not off the hook as a passive investor. You still need to do your due diligence. You still need to ask those questions. You need to really be able to understand what it is that you're investing in.
Yeah. And I think even we talked a little bit about, maybe the perfect burn not being able to happen because you have to keep some equity in order to cash flow, because financing is more expensive than it was over COVID. That's, I guess, another point to touch on. And I know we were having a conversation about this pretty much the last week, is about cash flow, right?
Yep.
Where right now, maybe the focus isn't as much on, and I don't even know if focus ever should be really on how much is this property cash flowing versus what is the overall look of this project.
Yeah. What is the overall return? Yeah.
So, because cash flow, we have to figure out now how to make our properties cash flow better, just to even make sure that they're stabilized, right? We're probably not going to be rolling in it with the way financing is right now. Even financing, even expenses have shot through the roof. And obviously these are things, when we're running our numbers, if you're buying a new property, that you need to be taking into account that, even things like insurance weren't the same as they were. It's not the same as in 2019. It's gone up a lot. So if you're buying a new property, you want to make sure you're accounting for these. But if you already own a property and these things are skyrocketing, the focus is really stabilizing, making sure it's not taking any money out of your pocket, and then just kind of keeping things happy, keep it at bay, and not necessarily rolling in your cash flow.
Yeah. It's very hard to retire off of cash flow. You need a huge portfolio to really retire off cash flow.
Mm-hmm.
Yeah. I think
that's our opinion.
Yeah, absolutely. Basically, there should be more than one exit strategy. Always have more than one exit strategy. Have a plan B, have a plan C. You don't, like we said, nobody has a crystal ball. We don't know what's going to happen. You can make projections based on historic events and what the current landscape looks like. But we don't know what the future holds. So having more than one exit strategy is always recommended.
Yeah. And I think that's, again, setting expectations with who you're working with, if you have partners in a deal, just making sure that everybody's on the same page, that you're not making, you're not promising, right? You're not promising the refi will be here. You're not promising, money. These are all projections. These are what you're hoping to do. But have that conversation. If in 5 years, it doesn't make sense to refinance at that point, we need the flexibility to be able to say, right now is not the time to do this. Maybe interest rates have gone up significantly in 5 years and it doesn't make sense at that point. So setting expectations with everybody that's involved in your project and trying to be conservative. I think right now is really a time to be as conservative as you can. And that comes back to the cash flow thing, I think, as well, where maybe you're not rolling in it. You want to be conservative. You might want to have a higher reserve fund for a property if you need it to tap into. And I think right now it's about stabilization, making sure that everything in your portfolio is working,
Rock solid.
optimizing as much as you can, and, kind of getting the properties you own through this at this point.
Yep, absolutely. Through COVID, when interest rates were like 1%, some people got less than 1% interest rates. Like there was talks about negative interest rates through COVID. Like money was essentially free.
Ooh.
Right? Everybody was rolling in it. Fast money, boom, boom, boom. All these projects, because the market's going like this, all these projects are fast turnaround. Wholesales were like people were doing those like crazy just because by the time you closed on it, it was worth more. Right? Now the name of the game is slow and steady, right? Capital preservation. You may need to put more money into the deal in order to allow it to cash flow and for it to actually be a stable project until the interest rates maybe go down.
Mm-hmm. And I think something to keep in mind is it's like so many people want to put, and obviously it's nice when you can put less money into a project. Mm-hmm. Then you have more capital to use for other projects,
and
obviously.
And your cash on cash return is just naturally going to be higher as well.
So, obviously it's nice to be able to put less money into a project. But in times like this, you might have to put a little bit more money in. And it's important to remember that you haven't lost if you buy properly, you haven't lost that money. You're buying a good asset, and later you can tap into that equity if and when the environment changes.
When you have lost that money is when you are so leveraged that you're paying a lot in interest. That interest is lost, right? Mm-hmm. That interest is you're spending that to be able to borrow more.
So it's right now it's balancing, it's stabilizing, it's not over leveraging, it's being as conservative as you can. And something that we talk about, especially with people who are buying in the commercial space, is run your numbers properly and then look at the cap rate for that building and then compare that with the cap rate of the area. And if you have a really high cap rate for the area and the building's performing really well for that area, maybe it's worth putting a little bit more money into that property in order to have that property in your portfolio. And then down the road, you can access that equity at another time. But at least you were able to put that little bit more money in, get that property, and now it's in your portfolio.
Yeah. And real estate is hedged against inflation, right? So if you're putting more money into that asset, it's capital preservation at this point, mm-hmm. right? Again, if you can refinance later when it makes more sense, when the interest rates are lower, then absolutely. And then you get access to that capital again. But at least inflation is not eating away at your dollar.
Mm-hmm. Yeah, I know for myself, I've been running numbers and I'm looking at these numbers, and sometimes I'm getting cap rates at over 6 in Ottawa, which is not a 6+ market, but the deal still isn't cash flowing because of financing.
Yeah, the debt service tends to kill a lot of deals today.
So I'm like, okay, if this project is that good, if it's performing well for the market that it's in, it might be worth putting that little bit of extra in, making sure it produces well, and then tapping into it later. So, and of course, we're not saying this as like a blanket statement. These are just things to keep in mind. And again, tools to have and things to think about in the environment that we're in. So this is not like go and start putting in 50% down payments on every property just in order to get it. That's not what we're saying. It's just have these thoughts where, maybe this property is worth putting, 30%, 35% down payment into because it's such a good opportunity. And then, later we'll do the refinance and tap into it.
Yeah.
So I just wanted to.
It's not all about loan to value. It's not all about being able to get 90% loan to value, because you know what? You're taking on so much debt at that point that with the interest rates today, I'd be surprised, right? It depends on the deal, obviously, but it's going to be a lot more difficult to cash flow when you're higher leverage.
Yeah. So I think the theme of this is really the market has changed. Mm-hmm. Fast money, quick turnaround, not necessarily a thing of the past, but we're not quite there. at this time. It's time to slow things down, to change our
Stabilize.
mindsets, to stabilize, and to set realistic expectations for our projects so that everybody involved is aware of what is more likely going to happen with the project, and you're not like, nobody gets disappointed when things don't go maybe as you had projected, because again, crystal balls, they exist, but I don't have one that works that well. So
Nice summary.
thank you.
Hmm.
I think that was pretty.
That's everything we had, I think.
Yeah, that was. I'm sorry if it was like a little bit.
It was definitely
preachy.
ranty, but it was. I feel like in today's landscape, and there's a lot of the discussions we've been having over the last couple of months. Really, it was, I think, a necessary discussion to have.
Yeah, it's just it's resetting expectations on whether you are an active partner, whether you're a passive partner, no matter what your involvement is in a project. Just remember that owning real estate, it is a tangible asset. Like Jeff said, it's hedged against inflation. If you're doing it properly, it's still going to be a solid investment. It's okay if the returns aren't wild like they were 2 years ago. The nice thing is that you can hold this through this weird period right now, and it's a cycle, right? Things are going to change.
Yeah, slow and steady. We're talking about wealth generation here. We're not talking about get rich quick with real estate.
Yeah. So that's that. That's all we have for you today.
We have an event coming up.
Oh, that's not all we have for you today. That's not it.
If you're in the Ottawa area or willing to travel to the Ottawa area,
it's worth it.
There is a boot camp coming up. Obviously, what we've been able to talk about on these power lunches, these essentially 30, 40-minute sessions, are very tip of the iceberg. We can't get too in depth. This event is an intensive 2-day multifamily boot camp.
Yeah.
Put on your learning hats or toques, because it's in November. Might need your toque.
Probably need your toque, unfortunately.
Bring your pen and paper.
Actually, don't even bring a pen. You're going to get a pen. Don't even bring a pen.
That's true.
Don't even bring a pen.
Be prepared to write.
Yes. Stretch your wrists. That's what you can do.
QR code. Ooh, this is fun. QR code down below will get you to this website.
And a lot of what we talk about on these lives, this is stuff that we've learned through events like this boot camp. So, we don't just know these things. I wasn't born knowing stuff like
it didn't come from family.
Nope. Didn't come from school. Didn't come from my undergrad. Didn't come from my medical degree. None of that.
Yeah.
It came from events like this one. So the beautiful thing is, for everybody that is watching, we have been given 3 promo codes to give out, and we wanted to offer them to everybody that's listening right now first, because we love you guys and we love that you are always here hanging out with us. So if you want one of those 3 promo codes, send us a message and we can get that to you. And yeah, we'd love to see you there.
Yeah.
I think that's that.
Thanks for hanging out, guys.
We'll be here again next Tuesday, same time, new topic.
Yeah.
Cool.
To be determined.
Yeah, to be determined. All right. Have a great rest of your week.
Thanks, everyone.